All right, guys, welcome to another interesting session. And today we look at another interesting aspect. As you are aware that ACCA, especially the SBR questions, has been changed. Not significant change, but the questions has been structured in such a way that it now comes with a pre-populated spreadsheet where candidates are expected to update the spreadsheet based on the exhibit and information provided to candidates. So we take a look at the questions and demonstrate how the candidate are expected to answer the questions in the examination. So I will share my screen right away. So let's take a look at the question. So here's the question. For question A, so we are to you using Exhibit 1, explain with suitable calculations how the investment in vehicle should be dealt with in a consolidated financial statement for the year ended 30th September 2026. Right? Then the big part saying that we are to use the pre-populated spreadsheet response option and Exhibit 1 and 2 to update the extracts of the consolidated statement of cash flows to adjust for the disposal of vehicle shares and to amend for any errors or omission made by the director. So the A part is talking about the disposal by the entity. So how do we treat that? And we are expected to use only Exhibit 1. Why the B part is asking us to use both Exhibit 1 and 2. So, right, this Exhibit 1, this Exhibit 2. And this is the draft consolidated statement of cash flow, which we are to answer for the part B question. So, let's read the Exhibit 1. Right. So on 1st of October 20X4, you could purchase 60% of the ordinary shares of Doico. At this date, the fair value of Doico's identifiable net assets was $590 million. The non-controlling interest at acquisition was measured at fair value of $250 million. Goodwill arising on the acquisition of Doico was $50 million and had not been impaired prior to the disposal date. Then on 1st of April 20X6, he could dispose of a 20% holding in the shares of Doico for cash consideration of $140 million. Losing control. At this date, net assets of Doico, excluding goodwill, were carried in the consolidated financial statements at $590 million. Right? From 1st of April 20X6, ACCA has the ability to appoint 2 of the 6 members of Doico's board of directors. The fair value of ACCA's 40% shareholding was $300 million at that date. Doico's reported a profit for the year ended 30 September 20X of $123 million. Right? So that is the question. So in summary, we're told that ECO is the parent company. As 1st of October, it acquired an interest of 60% in Doisco's investments, right? And we're told the net asset at the acquisition of 509 million at that date, at the date of acquisition. And we're also told the non-controlling interest, NCI, at the date of acquisition, and also the goodwill that arise from the acquisition. Then, on 1st of April, we're told that 20% holding was disposed. Look at that. On 1st of April, 20X, 20% holding was disposed. And remember, the year end of the entity, based on the question that we are asked, is September. And there was a disposal that occurred on 1st of April, 20X. So you need to consider that date. Between 1st of April to September, how many months is that? That is April, May, June, July, August, September. That is 6 months. 6 months to the year end, it was disposed. You need to take note of that. And we're also told that the ECO has the ability to appoint 2 of the 6 members of the Doisco Board of Directors, right? And we're also told the fair value of the remaining 40% interest. You know, when 20% was disposed from the 60%, what is left after that is 40%. And the fair value of that 40%, we're told that it is $300 million. And the Doisco has the profits at the year end of September to be 125 million. So the question A part. So, which asks us to use exhibit 1 on, let's call this solution, right? For the A part, we have to use exhibit 1 to explain the receivable calculations, how the investment in Doisco should be dealt with in the consolidated financial statement for the year ended 30th September 2026, right? So, explanation. Explanation. Can start by saying that the disposal of 20% interest from 60% lead to no control. Lead to no control, right? Lead to no control. When entity loses control of a subsidiary, what will happen? The goodwill, net assets, and non-controlling interest will be recognized from the consolidation. Consolidation, right? So you need to recognize the goodwill necessary from consolidation. Then when you recognize it, they recognize the goodwill, the net assets, and non-controlling interest from the consolidation. You not derive the profit or gain. The profit or loss on disposal will be calculated by subtracting the proceeds, including the fair value of the remaining shares in Doisco from the net assets, goodwill, and NCI at acquisition date. The profit or loss will be see calculation below. So then we can now calculate whether it is a profit or loss on disposal. So you can say profit or loss on disposal I'm going to say and say everything is in millions of dollars. You know the formula for calculating profit or loss on disposal. We start with the proceed. Proceeds. What is the proceed? On this already pay, it will dispose for cash consideration of 140 million. Come here, you said 140 million. What is the fair value of the remaining interest? The fair value of the remaining interest, we were told the fair value of the equal 40% shareholding was 300 million. We come here, we said 300 million, right? We add it together. The line. Then we deduct the net assets. Net assets at disposal. What is the net asset at disposal? Most of it pay. Control the net asset of the eco excluding goodwill will carry out in the consolidated of statement at 590 million. That is 590. Then goodwill. We're told that the goodwill. What is the goodwill? The goodwill arising on the acquisition of Doisco was 50 million and had not been impaired. So no impairment on goodwill. So you use the old figure, $50 million, right? Then NCI at disposal. NCI at disposal. How do we get that? NCI at disposal. Are we giving it directly? Let's check it there. The non-controlling interest at acquisition was measured at fair value of 215 million. So at the date of disposal, we're only giving the net asset at disposal, no NCI at disposal. So we can derive that NCI at acquisition is 215 million. At acquisition, $215 million. $215 million. Remember, the net asset at the date of acquisition of Doico is 215 million. And this investment, that Doico was, the 20% interest in it was disposed on 1st of April, right? And we're given a net asset of Doico at the date of acquisition. Definitely before the disposal, the net assets of the Doico is 510. And before the disposal, I mean, at the date of disposal, the net asset of Doico is 590. Then at the date of acquisition of Doico, its net asset is 510. It means that the net assets has increased in value, right? From 510 to 590, which then means that it has made a profit between that period. So how do we now determine the share of the NCI at the date of disposal? We come here, share of NCI, which is going to be equal to, bracket open, the 590 minus the 510. Then what is the percentage of the NCI? Then know the parent company. ECO was having 60% interest. The NCI then was 40%. So the NCI is 40%. 40%. So what do we have? We have 32. That is our NCI at disposal. We come here and say equal to, let's put it in brackets, NCI is supposed to be deducted from the addition of net asset and goodwill. Equal to, bracket open, 215 plus 32. What do we have? Right. So we now have the addition of net assets plus goodwill plus NCI. What do we have? We have 393. So this will now be deducted from the addition of the proceeds and the fair value of the remaining interest. 440 minus 393. What do we have? We have 47. We have 47. That is the profit on disposal. When there is a profit on disposal, remember that this needs to be reflected in the consolidated financial statements, in the consolidated statement of cash flow, right? Now, Continue with the explanation. The remaining interests of ILCO in Doy's pool is 40%, which then means that ILCO has significant influence in Doy's school, in line with IAS 28. In line with IAS 28, investments in associates and joint venture. In new ventures. In line with IAS 22 investment association and joint ventures, significant influence exists where an entity has between 20% to 50% interest in an investee. Right? We're also told that ILCO has the ability to appoint 2 of the 6 members of the Doy's Pool's board of directors. Right. The significant influence is evidenced by the ability of ILCO to appoint 2 of the 6 members of the Doy's board of directors. Right? They're board of directors. Then remember, this investment is now an associate now. How do we account for the associates? Right? The investments will be accounted for using equity method of accounting, right? Where the investments will be initially measured at fair value of, we're given the fair value of what? Of the remaining interest, 300 million. Fair value of 300 million, and reflect the share of profit of associates at 30th September 20x6. I think the September 20x6. That is September 20x6. That is the year end. Then we calculate what is going to be the share of profit of the associates. Save calculation below. We need to complete this sentence there that they made a profit of 47. Right? And the profit of 47. So let's calculate the share of profits of associates. Share of profit of associates. Remember, the investment, that 20% was disposed on 1st of April 20x6, right? And from there, that was when ACCA's investment in Doisco becomes an associate. From that 1st of April to the year end, how many months do we have there? April, May, June, July, August, September. That is 6 months. So we're told that Doisco has a profit of 123 million. So what is the share of the profits now? Share of profit as associates is going to be equal to 123 million times percentage of the associates, 40%, times by apportioning the date, the time apportionment, which is 6 months divided by 12. What do we have? We have 24, right? Therefore, the fair value of the investments in associates will be, that is 300 million plus 24.6 million. That is 300 plus 24.6, right? This will be reported in the Consolidated Statement of Financial Position. This in the Consolidated Statements of Financial Position. Right? Good. And that is sorted. What else again? We're going to trade it. So that is on the disposal of 20% interests. So let's go look at the exhibit the question B part. The question B part said, using the pre-populated spreadsheet response option and exhibit 1 and 2, update the draft extracts of the consolidated statement of cash flow to adjust for the disposal of those cost shares and to amend for any errors, omission made by the directors. So we are to use exhibits 1 and 2. All the information that we use there, we need to use it to update the consolidated cash flow statement. We have read the exhibit 1, so let's look at the exhibit 2. Now, this is exhibit 2, which says that the group's financial controller has produced draft extracts of the consolidated statement of cash flows and has not yet considered the impact of the disposal of those costs, exhibit 1. There are also some errors. All other consolidated financial statements have been correctly prepared. The draft extracts have been included in the spreadsheet response option, right? The carrying amount of the net asset of dwelling costs on 1st of April 20X6 were as follows. We have property, plant, and equipment. We have inventories, trade and other receivables, cash and cash equivalents, trade and other payables. And they have a total net asset of 590 million, which is what we have in exhibit 1. So it goes further by saying that the statement of cash flows figures for inventories, trade and other receivables, trade and other payables, and property, plant, and equipment have been calculated by considering only the movement in the balances between the consolidated statement of financial position from 30 September 20X5 to 30 September 20X6, right? He could exchange property, plant, and equipment with one of his suppliers on 1st of November 20X5. It is estimated that the fair value of both assets exchange was $50 million, although the carrying amount of the asset transferred by Hilco was $45 million at the date of transfer. There were no other disposal of non-current assets by the group during the year other than the disposal of Doico. The group also acquired property, plants, and equipment during the year for cash. Depreciation charge at the group for the year ended 30 September 20X6 was $775.1 million. So that is information that relates to the cash flow here. So in summary of what they are saying here is this, right? That there are also some errors. That is, they say that the extract of the consolidated statement of cash flows and has not yet considered the impacts of the Doyle's cost, that is disposal of Doyle's cost, the disposal of Doyle's cost, that is disposal from being a subsidiary to associates has not been considered in this cash flow that's being presented to us. This draft consolidated cash flow does not consider the impact of the disposal, right? Every other thing, all other consolidated financial statements have been correctly prepared. So we are not sure of that until we check, right? So we are given the carrying amount of the asset of Doicos at the date of disposal, which is on the 1st of April 20X6. So we're giving him the PPE, the inventories, the trade, receivable and payable. We have the cash, trade and other payable, and we have the total of 590, right? Then here, look at it here. They are saying something on the inventories, trade and other receivable, trade and other payable, and property, plant, and equipment have been calculated by considering what? Only the movement in the balances between the consolidated statement of financial position. That is, they only consider the movement between 20x5, between 30th of September 20x5 and 30th of September 20x6. Remember, 20x is the year ends. Why the 20x5, started September 20x5, is the opening balance, is the beginning of the year. Why the September 20x6 is the closing year. That is only thing that they consider. It means that they not consider anything that happened in between those years. And remember, there was a disposal of a subsidiary during the year, which means that it has not been considered. So those are the areas that we need to look into while we are updating the draft consolidated statement of cash flow, right? Good. So let's take it one after the other. So you have to use exhibit 1 and 2. Which information do you need to derive from exhibit 1? Let's go to our calculation here. Here, starting from here, we calculated profit or loss on disposal. We calculated profit or loss on disposal. So how do we treat that? We have a profit on disposal of 45 million. So we come here. You know the format for the preparation of cash flow from operating activities before profit before taxation, adjustment for, you need to do those adjustments, right? Profits from disposal. Come here, you can say disposal. How much is that? Say it's 47. Profit from disposal, right? That profit from disposal is a non-cash items. So what do? We are going to deduct it, right? Then what else again? Our calculation, profit from disposal, I've taken care of that. Then profit, share of profit of associate, you need to consider that as well. It's a non-cash items. You come here, you say, share of profit of associates. What do we have? It's a non-cash item. I think it's 24.6. It's a non-cash items. Associates. Right? What else again? Do we need exhibit 1? What else again do we do in exhibit 1? So proceeds, they dispose and they receive a proceed of 140 million. So we come here, we said proceeds on disposal. So proceed on disposal is an investing activities. So we receive it cash from operating, operating activity, net cash flow from Net cash used in investment activities. Net cash used in investment activities. Cash flow from investment activities. So we come here. How much is that? 140. Proceed from disposal. Right? So what else again? What else again we do? What information do we need again? Proceeds, fair value, remaining interest. I think that is all on exhibit 1. Right? That is all on exhibit 1. So remember, in the consolidated cash flow, when you dispose a subsidiary, and also when you acquire a subsidiary, what you are going to recognize in your investment activities is going to be the net of the proceeds or net of the consideration that you paid, right? For instance, now, in the case of ACCA dispose its interest in Doicos, and it moved from being a subsidiary to associate. That means that it does not have control of Doico. And remember, Doicos in its financial statement will have a cash balance. That cash balance will no more be out of the control of ACCA, right? So the proceed that you receive from it is going to be the net of that cash balance that that subsidiary has at the date of that disposal, right? So let's look at the cash balance by it has there. It has a cash balance, cash and cash equivalent of 20.9. So you need to take note of that. Come here and say 20.9. Cash balance of Doico, right? So it's going to be net minus, right? So let's move to exhibit 2. What information do we have there? Let's start from the beginning. Right here, when they are saying that the cash flow has not yet considered the impact of the disposal, right? So we're given the carrying amount of the net asset, right? So starting from the property, plant, and equipment, and somewhere here we're told that they acquire plant and equipment during the year for cash. We're not given the cash, so we can derive the cash. So you can come here and say the consolidated statement of cash flow. Statements of cash flow. right? And say working one. Working one. Working one will be on PPE. PPE. Right? I can use the T format, I can use the ledger format. Let me use the ledger format. You know, that's what most of us are familiar with. So I can say this debit, this credits. You can expand this. Right? So this is the debit side, this is the credit side. Let's look at the information given to us on PPE. This PPE that is part of the joint code dispose. Here we are given the information on PPE. The PPE as at 20x6 and 20x5. 20x5 is the opening balance, while 20x6 is the closing balance. So we come here, opening balance, opening balance. What is the opening balance here? Opening balance is 4219. You can copy and paste it there. Then closing balance. Where's the closing balance? 429, 4953. 1953. And we're given the PP that was disposed, which is 3119. Disposal. So it needs to be credited. Disposal. Theory 11.9. Right? 3311.9. Which information again has to do with PPE? There's main mention of something on PPE here. Right? Only the movement in the balances. Equal exchange property, plant, and equipment with one of its suppliers on 1st of November 20x5. Like during the year, it exchanged the property. It is estimated that the fair value of the both assets exchange was 50 million, although the current amount of the asset transfer by ECO was 45 million. Asset transfer, when you transfer the assets, is going out. Asset transfer at the current amount, which is what? Is 45 million, and the fair value is 50 million. So we come here, amount transfer 45, fair value, 50 million. All right. What happened there? They transfer a property to a supplier. To who? To his suppliers. And the carry amount of that property is 50 million. The carry amount is 45 million, and the fair value of it is 50 million. So they exchange, they give out 45 and they got 50 million in exchange. So in that case, a fair value and the carry amounts, definitely there will be a gain from that. You can come here, I can say working 2, asset exchange. Fair value 50, carrying amounts 45. So what is the difference? Minus 45. That is a gain. Fair value gain of 5. Right? So we need to consider that in our cash flow. Right? So what is the total of this? Is there any other information that has to do with PPE? Plant and equipment during the year, acquire property, plant and equipment during the year for cash. So that is the cash that we are trying to derive. Okay, you can see here the depreciation charge of the group for the year ended at 30 September 2026 was 775.1. Depreciation. We need to consider that 775.1. Depreciation 775.1. So which one is the highest between the two? And say what is the total of this debit balance what is the credit balance? So what is the difference? There's going to be the credits is higher than the debit. This minus this. What do we have? Difference. That is 11815. That is the actual cash used to acquire PP during the year. So 2 items here. We are going to report this 1811 and this 5. So we come to our draft cash flow statements. Purchase PP is a cash outflow, which is 181. One 5.8. 5.8. Purchase of property, plant, and equipment. You can notice something here. The entity has already reported 73.8 as a cash outflow as a result of acquisition of property, plant, and equipment. But the actual amount used to acquire PPE for the year is 1815. So we need to correct that. So what is going to be the difference between that 733.8 and 181.5? That is what we are going to report there. So we can say this one is plus 733. What do we have? So what we are going to report here is 1082. 1082 negative. Right? So we need to take care of this. We need to take care of that fair value gain. It's a non-cash item. PP fair value gain of 5. Come here. Minus 5. PP exchange gain. Right? What else again? Move to the exhibit 2. So we have taken care of the PP. The inventories. This inventory, we're told something here that inventories, trade and other receivables, trade and other payables, and property, plant, and equipment have been calculated by considering only the movements in the balances between the consolidated statement of financial position from 30 September 20X5 to 30 September 20X6. So we have treated that of the PP. It remains the inventories. What they are saying here is this. The movement that we are seeing here for the inventories, receivables, and payable is only the movement between that of the 30 September 20X5 and 30th of September 20X6, which means that 20X5 is the opening balance, which will serve as the opening balance, while 20X6 is the closing balance. They did not consider what happened in between the 2 years. They did not consider what happened during the year. And we all know, we are all aware that there was a disposal that happened during the year that led to the recognition of the NCI, goodwill, and what? The net assets of the subsidiary. It has not been considered. So we need to consider that in our treatment of the consolidated statement of cash flow, right? So how do we treat this? So we need to pay attention to this particular area. It's somehow complicated and it's very simple if you understand it very well, right? In this draft consolidated cash flow, what we have here, these are the movements. That is the closing balance minus the opening balance. This is what we have here. But the ND has not considered the disposal that happened during the year. So how do we now treat this now? How do we treat this? Right? So, in summary, this is what we need to do in this situation. This is what we need to do in this situation. When there is an acquisition of investment during the year, and you have a movement given to you, and there is an acquisition, and that acquisition has not been considered, what do you do? you need to deduct that balances of the acquisition that happened during the year from the movement balance, right? Let me repeat that again. If there is an acquisition of a subsidiary and that asset of that subsidiary has not been considered in the movements of the consolidated cash flow, especially on the working capital, what you need to do with that movement is what? Is to deduct the subsidiary that was acquired, the asset of subsidiary that was acquired from the movement, right? Then, if there is a disposal during the year, and that disposal has not been considered in the movement given to you in your consolidated statement of cash flow, what you need to do to correct that is what? Is to add the asset of that subsidiary that was disposed to the movements. Let me put that down so that everyone can grab it. If um right, if there is a disposal, there is a disposal. If there is a disposal, add to the movements, right? If there is an acquisition, deduct from movements, deduct from movements, right? Let me just demonstrate this here. You know that your movements that you have here, your movements that you are given in the consolidated cash flow statement is derived by deducting the difference between the closing balance from the opening balance, right? That is closing minus opening will give us movements, right? It will give us movements, right? So let's assume that the closing is 100 million and the opening is 30 million. So our movement is going to be closing minus opening, right? Which is 70 million. Let's assume that the entity disposed an asset, disposed a subsidiary during the year. And in that subsidiary disposed, there is an asset that worth 10 million, right? In that disposal, which means that it has not been considered here in this 30 million. When you dispose a subsidiary, what will you do? You also deduct it from your opening balance to know the exact value of your opening balance, right? So in this situation now, this 10 million has not been deducted here. This 30 million that we have there, we can say it is what? It is overstated. Because this 10 has been disposed from it. It's supposed to have been deducted. But we did not, the entity did not deduct it. What happened? It made this 30 million to be overstated. If this 30 million is overstated, it then means that this movement is understated. So what do we do? When something is understated, for you to make it balance, what will you do? You add it, you add up with it, what is making it to be understated, right? Right? So if you add the 70 million to this 10, what do we have? 70 plus this 10 will give us 80, right? It will give us 80. So let's check this now. Let's check this. This one's supposed to be 80 million. It's supposed to be 30 million. It's 30 million, but it's supposed to consider the disposal of this 10 million. What do? We deduct it. Say 30 minus this 10. What do we have? Can see it has increased to 80 million, right? It has increased to 80 million. This is 80, right? So that is what I just demonstrated here. That is what this actually means. When there is a disposal, you add that asset of that subsidiary disposed to the movement. It will give you what you need to report in your consolidated cash flow, right? The other part is that if it is acquisition, what will you do? You deduct. Let's change this back. This one is 30, right? So now, the entity acquire an asset during the year. In that asset of subsidiary acquire, there is an asset that worth 10 million, right? So you are giving a movement of 70 million. You are giving a movement of 70 million. So how will you treat this direct? What you need to do is, it's an acquisition. What you need to do to make it balance up is to what? Is to deduct the asset of that subsidiary from the movement. That is, we deduct this 10 million from 70 million to arrive at the actual figure that's supposed to be there. So you can say equal to 70 acquisition minus 10. It will give us 60, right? So now let's check this now. Remember again, this is the closing balance, this is the opening balance, and we have a movement of 70. In this opening balance, we acquire an asset of 10. It has not been considered in this 30 million. Normally, we're supposed to add it to the opening balance to know the actual value of that opening balance, right? But the way it is now, this 10 million is not included here. It means that this 30 million is understated. If this 30 million, if the opening balance is understated, it means that this 70 million is overstated. And if this movement of 70 million is overstated, what will you do? You deduct to arrive at what will be there. That is why we have 60 million here, right? Rather than going through this route, you can just check by saying that, yes, this 30 million is understated. We need to correct it by adding the 10 million from the asset, from the subsidiary acquired. So it's saying 30 plus the 10. What do we have? We have 60 now. You can see they are now 60, 60. So we can use this logic to solve a situation like that. If it is a disposal, what will you do? You add to the movement. If it is acquisition, you deduct from the movement, right? I hope that is clear. So now let's solve this now. For the inventory is 200.5 million, right? And we have a movement of 842 million. So it is a disposal. If it's a disposal, what will you do? We add to the movement. We come here, we say inventory. No. You can say what's generally you can do to everything here? Working capital. Working capital for the inventory is a negative. It's a disposal. If it's a disposal, what will we do? We add the assets of that subsidiary. And how much is that? 200.5. You come here. It's negative. For us to increase it, for us to add it, it has to be negative as well. It's saying minus it's saying minus 200.5. Minus 200.5, right? Then for the trade and other receivable, 181.3 is a disposal. What do? We add. We want to increase it. So it's in negative already. What do? We make the what we're adding to be negative. 181.5. Is it 0.5? Let's confirm. 181.3. Sorry. Right. Then for the trade and other payables, 124.6. 124.6 is a disposal. What do? We add. If we are adding, this one is already in positive, so we have to leave it in positive. 124.6. So this 200 is supposed to be in negative. Right? Then that is settled. Then again, there is a depreciation. It's a non-cash items. Depreciation. Depreciation. Then we've settled that. We have treated the cash as well. What else again have we not settled? That is depreciation of 775.1. So we come here 775.1. 775.1 million. Right? So we call this depreciation. So everything here is in $1 million. What else again have we not settled? Have we not treated here? So let's look at the exhibit again. 590 USD, 50 million. 50 million. We've treated that. 775.5, 775.1. We've treated that. We've treated all the items here, right? So if you're in an examination, this way you can stop. You do not need to balance up by saying corrected adjustments, corrected balance. This may not be necessary because your marks will be based on posting of each of these, right? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, just like that. Because there is no mark for this, what I'm doing right now. There is no mark for this. Some there's no mark for this. So with this, get your full mark. There's no mark for this. Once again, I'm repeating it. You don't need to waste your time in doing all this again. Right? So there's no mark for all this I'm doing now. You have concluded the questions, right? Although you should still have time left during the examination, you can still do this, but once again, there is no mark for showing the correct balance. Your mark will be based on your postings, which are all these figures here. Right. So we've answered the questions. So as I said earlier on, there are no marks for all this line item here. You do not need to waste your time, start calculating them, start balancing them off. Right? Your marks are based on all this posting that I'm touching here, right? Down there. So that is on the pre-populated question, which has changed part of the structure in which the ACCA SBR question is being asked. So it's very important that candidates solve more of these questions. There are also questions that are related to this on the consolidated statement of profit or loss and the consolidated statement of financial position. So I will encourage candidates to attempt some of these questions so that they can familiar with how they are being treated, so that it will not be a new thing, a new question to the candidate during the examination. Yeah, thank you very much for your time. If you have any questions, you can put it on the chat box or in the comment section. I will surely respond to them. Thank you. Have a great day. Bye for now.